Now that you understand what a stock is, a tiny slice of ownership in a company, the next question is, how does that slice even come into existence? After all, companies don't start out with their shares trading on the stock market. There's a process that turns a privately owned company into one that anyone can invest in. And the heart of that process is something called an initial public offering, or IPO. An IPO is when a private company decides to go public by selling pieces of itself, shares, to outside investors for the very first time. Before the IPO, ownership of the company is usually limited to its founders, a small group of early employees, and perhaps a handful of private investors like venture capital firms. When the company is ready to grow beyond what private money can provide, it chooses to raise a large amount of cash by offering shares to the public. That first sale of shares to regular investors is the initial public offering. Think of it like a local bakery that has become a neighborhood favorite. The bakery has long lines every morning, and the owners dream of opening two more locations across town. But building new stores, hiring staff, and buying more equipment costs more than the owners have in savings. To raise the money, the bakery owners decide to sell small pieces of their business to people in the community. Neighbors can buy these pieces and become part owners. In exchange, the bakery gets the cash it needs to expand, and the new part owners will share in the bakery's future profits. That's essentially what happens in an IPO, just on a much bigger scale. And instead of your neighbors, it's investors from all over the world. When you hear phrases like going public or being listed, they mean the same thing. The company's shares are moving from private hands to a public marketplace. Being listed means the company's stock is officially available for trading on a stock exchange, like the New York Stock Exchange or the NASDAQ, where anyone with a brokerage account can buy and sell those shares. So, why would a company want to go through all this effort? There are two main reasons. The first is raising capital for growth. Just like our bakery needs money to open new locations, companies need funds to develop products, hire employees, or enter new markets. Selling shares to the public can raise billions of dollars. The second is providing liquidity for early investors and employees. Early backers, like venture capitalists or employees with stock options, can finally sell some of their shares and turn their paper wealth into real cash. Behind the scenes, the company works with investment banks, sometimes called underwriters, to set the initial share price and market the offering to big investors. They prepare financial statements and go through regulatory checks to make sure everything is transparent and legal. On the day of the IPO, the company's stock begins trading on the chosen exchange. From that moment on, the price of the stock is determined by supply and demand in the open market, just like any other stock you might buy. To recap, an IPO is the bridge from private ownership to public ownership. Going public or being listed simply means the company's stock is now traded on a stock exchange. The main goal is to raise capital and give early investors a way to cash out, while allowing new investors to own a piece of the company. That's how a company makes a stock and invites the public to become co-owners. In the next part of the course, we'll explore what happens after the IPO, how the stock market itself works as the giant marketplace where these shares are bought and sold every day.